Welcome to The Explainer. We are actually throwing the usual agenda right out the window today because there's a highly urgent global catalyst unfolding as we speak. It's driving the silver market into what can really only be described as a perfect storm. We're going to break down the exact math, the global macroeconomic engine behind it all, and a precise geometric setup that has literally been building for half a century. Okay, let's just dive right into it. $98. That is the explosive price of Brent crude oil we're looking at right now. Just let that number land for a second, because literally 3 weeks prior to this data, oil was sitting quietly in the low 70s. We're talking about a massive 40% spike in under a month. And this isn't just some random number. It's the burning fuel underneath this entire precious metal setup we're about to explore. So what's the real-world event creating this severe supply choke point? Well, the geopolitical spark involves recent strikes by Yemen's Houthis on 2 Saudi Arabian oil tankers. Because of this, traffic through the absolutely critical Strait of Hormuz is currently running at near zero activity. Now, when you combine waterways under pressure with global oil inventories that are rapidly draining week after week because, the world is consuming from storage instead of supply, you get an immediate, intense inflation pressure cooker. Every single barrel that doesn't move just becomes a barrel of inflation later. Section 1. Silver's half-century setup. Okay, so now that we understand the massive global oil catalyst, we're going to zoom all the way in from that macro scale right down to the microscopic geometry of the silver chart. We're setting up what we can call the rule of 3 signals. These are 3 distinct historical and mathematical alignments that are currently converging. But to understand why this is such a big deal, we first need to define what we're actually looking for here: confluence. In technical analysis, confluence is when independent, completely unrelated charting methods all point to and agree on one single price zone. It basically takes the passionate, sometimes crazy-sounding claims we hear in the markets and grounds them in pure math. Confluence is, for all intents and purposes, the closest thing a technical analyst has to absolute proof. Let's look at how this confluence builds over a massive 50-year timeline. Silver has an underlying monthly trend line that is roughly half a century old. Just think about what has happened in the world while that single line has defined silver's structure. We've had the fierce inflation of the 1970s, Black Monday in '87, the dot-com crash, 9/11, the 2008 financial collapse, and of course, a global pandemic. Every major crash and boom of the modern financial era has occurred, and yet silver has walked all the way down, touched that exact historical structure, and successfully backtested it. That is the market's deepest memory, holding incredibly firm. And that actually brings us to our second massive signal, which we find on the quarterly chart. For almost half a century, silver has been carving out this giant rounded bowl structure. And running right across the top of that bowl is a horizontal shelf right at the $50 mark. Now, for 44 years, that $50 line was a hard structural ceiling. But as we know, in markets, old ceilings become new floors. That historical barrier has fundamentally flipped to become the market's new foundational support. Section 2. The golden ratio target. All right, so we have the 50-year trend line and the 50-year rounded bowl. Now we transition to the third and honestly the most precise signal of them all. When a market pulls back from a massive run, traders watch for the golden ratio, the 61.8% retracement level. When you actually crunch the numbers on silver's epic historical run, from $11 all the way up to just above $122, that 61.8% golden ratio lands exactly at $53.95. The actual market low of this recent correction, it was $54.74. That is an astonishing, microscopic 79-cent difference over a multi-year trend. That isn't just luck, folks. That is a market strictly obeying its own pure geometric math. So we have 3 completely independent methods: the timeline, the bowl, and the golden ratio, all pointing at one specific zone. The setup is fully loaded. But that brings us to the critical question. What does this complete 50-year confluence setup still need to actually fire? It needs one specific trigger. And here is that magic number, $63.30. A clean close above this exact price level is absolutely required to take out the structural high of the recent decline. It essentially breaks the back of the downtrend. Until silver definitively closes above $63.30, everything we've just talked about is really just a beautiful, loaded setup waiting for permission to run. But once it breaks that number, the entire character of the market flips from selling rallies to buying dips. So, what happens the moment that trigger is pulled?
Well, a very specific roadmap unfolds. Step one is breaking that $63.30 level. But step two is where most people get shaken out. The market will very likely pull back to retest the 58 to 62 zone. If it holds there, step three is a clear magnet target at $67, which is the 50% retracement level of the whole move. And then step four is the next impulse target at $80, matching the shallower 38.2% retracement. The geometry is literally mapping the way up for us.
Now, I really want you to focus on step 2 of that roadmap for a second, that retest of the $58 to $62 zone. The source material points out something absolutely vital about investor psychology here. Great entries always feel wrong. When silver pulls back to retest that breakout, the headlines are going to be screaming that the breakout failed. The bearish voices will be incredibly loud. But structurally, that retest is intended to be the single best entry point of the entire correction, precisely because it feels so unbelievably uncomfortable to take. Section 3. The ultimate inflation trap. Let's zoom back out from all that precise chart geometry for a minute and look at the global macroeconomic engine that is forcing this whole scenario to play out. Because, a technical setup without a real-world catalyst is really just a pretty picture on a screen. And that catalyst is a totally unsolvable problem for central banks, driven by that $98 oil we talked about earlier. Central banks are caught in a brutal dilemma right now. They cannot fight supply chain energy inflation using their traditional tools. You can't just hike interest rates and magically make a tanker safe or force a waterway open. If they raise rates, they just slow down an economy that's already fragile. But if they don't raise rates, long-term interest rates climb on their own, and the government's interest bill just explodes vertically. Which brings us to the logical historical endpoint of this entire inflation trap: yield curve control. When a government can't afford higher long-term rates, but also can't stop energy inflation, the central bank has to step in. They buy whatever bonds they must to hold those rates down. Simply put, this requires massive, unlimited money printing just to protect the government's own debt. And historically speaking, there has never been a more powerful fuel for precious metals like gold and silver than a central bank being forced to choose between protecting the currency and protecting the state. Section 4. Risk and reality. Now, we definitely need to ground this explainer in reality for a minute, because as clean and as historical as the setup is, a setup is never a guaranteed trend. The source explicitly outlines these risk parameters so you don't get caught front-running this emotionally. First, it absolutely needs that clean close above $63.30 to confirm the momentum. Second, there's a hard invalidation line. If we get a weekly close below the $54 to $55 area, that completely breaks the golden ratio structure we discussed earlier. And finally, always remember that oil is a double-edged sword. While it fuels the long-term inflation logic, violent short-term energy spikes can actually cause broader market margin calls. And when that happens, metals are often sold off first for liquidity. So all the pieces are on the board, right? A half-century trend line, a 44-year ceiling flipped to a floor, a golden ratio hit within 79 cents, and an unsolvable global inflation trap brewing in the background. It is all just waiting for one single number to pull the trigger. So we're going to wrap up this explainer with a really provocative question directly from our source material, challenging your own market psychology. If that breakout happens and that incredibly uncomfortable retest hits the high 50s, will you actually trust the setup, or will you let the headlines talk you out of it? Thanks so much for joining us for this explainer, and definitely keep your eyes on the data